our topic, types of insurance. You can see in the image the types are there. One side life insurance is there and another side general insurance is there. In general insurance, another subdivision is there like marine insurance, fire insurance, other insurance. In other insurance, different types are there, in which we will see the health insurance in brief. Others are like this burglary insurance. It is for the some kind of incident take place at our home or in business. Cattle insurance is for cows, buffaloes and etc. Crop insurance is there. It is a provided protection against the failure of crop to farmers. Sports insurance is there. It is for the person who is playing sports for the personal pleasure. Amarth Shiksha Yojana is there. It is for the education for the dependent children. It gives protection to them. Rajeshwari Mahila Kalyan Bima Yojana is there. It is specially designed to give protection to women in the case of death or disability. And health insurance is there. Vehicle insurance is there. So about all these things we will see one by one. Let's see first life insurance. Life is uncertain and there is risk of unforeseen events and happenings. The risk may be of an event which is certain, that is death. In the case of early death, what will happen to the family members who are dependents on the income of individuals, and living too long is also a risk when individual become too old and even not able to earn, or earning declines, or there is no earning after retirement. Under such condition, individuals need protection against risk. Life insurance companies offer protection against such risk. A life insurance policy provides protection against the uncertainty of life. Now various types of policies are available which fulfill different requirements of an individual, like disability insurance is there, health or medical insurance is there, annuity insurance is there, etc. Now let's see first what is life insurance. Life insurance is a contract in which insurer agrees to pay the sum assured amount to assured or to the person for whose benefit policy is taken, you can say nominee here, on happening of a specified event like death or expiry of certain period. For this, the certain amount is paid to insurer and it is called premium. It may be paid either in lump sum or in installments like monthly, quarterly, half yearly or yearly. The terms and conditions are mentioned in a document called policy. In insurance, one side insured is paying premium and on other side insurer is promising to pay certain amount to beneficiary at the event of death or expiry of certain period. The person whose life is insured is called assured. Remember this. It is providing protection to the family at the time of premature death, or gives fixed amount at old age when earning capacity are reduced. Insurance is also one kind of investment because certain amount is returnable at the time of death or expiry of certain period. It also encourages savings because the amount of premium has to be paid regularly. It provides sense of security to the insured and his dependent. Now let's see main elements of life insurance contract. First is the life insurance contract must have all essentials of a valid contract, like offer and acceptance should be there, free consent should be there, capacity to enter into contract should be there, lawful consideration and lawful object should be there. This all must be present in contract. Second, life insurance contract is a contract of utmost good faith, so the assured should disclose all material facts to insurer, even if the insurer does not ask to him. Third is the insured must have insurable interest in the life of assured. In life insurance, insurable interest must be present at the time of taking insurance only. It is not necessary that the assured should have insurable interest at the time of maturity. Some examples of insurable interest are there in the case of life insurance, like a person has insurable interest in his own life and every part of it. There is a husband and wife is there. They both have insurable interest in each other's life. Creditor has insurable interest in the life of debtor. Proprietor of drama company has insurable interest in the lives of actors. And last element is life insurance contract is not a contract of indemnity, because the life of a human being cannot be compensated, but only specified amount is paid, and this amount is fixed in advance while taking insurance policy. Now let's see types of insurance policies. To fulfill the different requirements of people, insurance companies have developed the different types of insurance policies, like whole life policies there, endowment life assurance policies there, joint life policies there, annuity policies there, children's endowment policies there. We will see one by one all of this. Let's see first whole life policy. In this kind of policy, the amount is payable to beneficiaries only after death of assured. The premium is payable for the fixed period of time or for the whole life of the assured. If the premium is payable for the fixed period of time, the policy will continue till the death of assured. Next is endowment life assurance policy. In this type of policy, the insured has to pay premium for fixed period of time, and the sum assured is payable to him after completion of fixed period or to his heir or nominee in the case of death, whichever is earlier. The endowment policy matures after a limited number of years. Next is joint life policy. This type of policy is taken for two or more persons. Generally, it is taken by husband and wife. Premium is payable in installments or lump sum. The policy money is payable after the death of any one person to the other survivor or survivors. Partners in partnership firm can also take this type of policy. Next is annuity policy. In this type of policy, the sum assured or policy money is payable after the assured attains a certain age in monthly, quarterly, half-yearly or annual installments, and premium of policy may be paid for fixed period of time in installments or single premium also paid by assured. This type of policy is useful to those who wants regular income after certain age. Last one is children's endowment policy. This type of policy is taken by a person who is worried about the expenses of education and marriage of his children. The certain amount is paid by the insurer when children attain a particular age. The premium will be paid by person taking insurance. However, no premium will be paid if he dies before maturity of the policy. Now let's see next type of insurance, that is fire insurance. This type of insurance is taken by a person who is worried about the loss by fire of property or goods. Generally, fire insurance policy is taken for a period of 1 year, and after which it is to be renewed from time to time. Amount of loss is specified in the policy itself. Premium of policy is payable in lump sum or installments. There are two conditions which must be satisfied before you claim of loss by fire. First is there must be an actual loss, and the second is fire must be accidental and non-intentional. Remember, the loss due to overheating without ignition, it will be not considered as loss by fire, and loss will not be recoverable from the insurer. Now let's see main elements of fire insurance. The insured must have insurable interest in subject matter. This is a very common to every type of insurance, otherwise it will be cancelled. And most important thing, this insurable interest must be present at the time of taking insurance also and at the time of loss also. like you have a insurable interest in your own property, or a businessman has an insurable interest in his stock, machinery or building. An agent has an insurable interest in the property of his principal. Partner has an insurable interest in the property of partnership firm, and mortgagee has insurable interest in the property mortgaged. Next is a fire insurance contract is also contract of utmost good faith. The insured must give all material information to insurer regarding the property or risk attached to it. At the same time, the insurer should also disclose all the facts of the policy to proposer. Third one is fire insurance is a contract of strict indemnity. When event of loss take place, the insured can recover the actual amount of loss from insurer, but the insured will get only the amount of loss or policy amount whichever is less. Suppose you are taking insurance of your house of rupees 10 lakh. So in the case of totally destroyed of your house by fire, the insurer will pay you rupees 10 lakh only, maximum 10 lakh only. If your loss amount is rupees 2 lakh, you will get rupees 2 lakh only, not the policy amount of rupees 10 lakh, because the person is not allowed to get gain by insurance. And the last one is the compensation is paid only when the loss is due to fire. Means fire is the proximate cause of damage or loss. Now let's see next type of insurance, that is marine insurance. Marine insurance provides protection against loss by marine perils or perils of the sea. Marine perils includes collision of a ship with rock, ship attacked by enemies or by fire, captured by pirates, or mistake of captain or crew of ship. Due to these perils, there may be a chance of destruction or damage of ship and cargo or goods on it. And there is a chance of disappearance of ship, and due to that non-payment of freight is also there. So many kind of risk is there, and that's why marine insurance is taken. It insures the ship also, the cargo or goods on it also, and the freight also. So this is a device where insurer promise to compensate the owner of ship or owner of cargo for the complete or partial loss at sea. Insurer guarantees to compensate the losses due to damage of ship or cargo arising out of risk to sea voyage. Here insurer is known as underwriter, and certain sum, that is premium, is paid by insured in consideration for the guarantee or protection. Marine insurance is slightly different from other type of insurance. It includes three things. First is a ship or hull, next is a cargo or goods, and the last is freight. Let's see first ship or hull insurance. There are lots of risk in sea for a ship. This insurance policy is taken to get protection against losses caused by damage to the ship. Next is a cargo insurance. There are many risks when goods are transported by ship. It includes at port, risk of theft is there, loss of goods is there at port, and loss of goods on voyage is also there. So cargo insurance is taken to get protection against risk to cargo or goods. And the last one is freight insurance. If cargo does not reach to the destination due to damage or loss is lost in transit, the shipping company will not get payment of freight. So freight insurance is taken to get protection against the loss of freight. Now let's see main elements of marine insurance. First is marine insurance is a contract of indemnity. In the event of loss, the insured get the amount of actual loss from the insurer. In any condition, the insured is not allowed to make profit out of marine insurance contract. Like cargo policy provides commercial indemnity rather than the strict indemnity. In hull policy also, amount assured is equals to the current market value, not more than that. Second, contract of marine insurance is also contract of utmost good faith. Both the insured and insurer disclose which is in their knowledge and that can affect the insurance contract. The insured must provide all facts accurately, which includes nature of shipment, risk by which it can be damaged, etc. Next is insurable interest must exist at the time of loss only. It is not necessary at the time of taking policy. And the last one is the principle of causa proxima will apply here also. The insurance company will be liable to pay only if that particular or nearest cause is covered by policy. If loss is caused by several reasons, then nearest cause of loss will be considered responsible. So here we have completed today's topic, types of insurance.